Hey everyone, welcome back to the REI Marketing Secrets podcast. Today on the show, we have Phil Moeller. And Phil, for our audience out there who's just learning about yourself for the very first time, do you mind just going into a little bit about your background and how you got started in real estate?
Yeah, that'd be great. So first, thanks for having me on from West Central Ohio. Married to my wife Marcia for I think 16 years now. We have five kids, ages 4 to 13. So we're very, very busy at home. Um, Went to school to be an engineer. Got out of that, went in the corporate world. Quickly realized I didn't love engineering. Went into the business side of the corporate world more. And in about, I would say, a decade or so, not quite into my career, I was like, okay, is there anything else out there? I was thinking about that, but also we bought a single family house in 2013. In reality, I actually really started thinking about it in 2011. I just analysis paralysis and other things that kept me from doing it. The main or the first goal, the first objective was because we started having kids around that time. My wife was a hairstylist and she had flexible hours, like it was just commission. So if she started to slow down how many hours she worked, like let's say she didn't want to work Saturday mornings, well, if she made, I don't know what she made on a Saturday morning. Well, let's just say she made $200 on Saturday morning. Well, if I can buy a house that can replace that income, or a couple of houses that can replace that income, maybe she can start to scale back her hours. So our first goal was to help my wife basically work less and be able to be home more with the kids.
Yeah, I like that a lot. I find that not a lot of people start off in real estate per se. It's almost like you're working. And that was for me as a passive investor. I'm working in my business. And I'm like, I don't want to be doing this business forever. How can I generate income that's not coming directly from my business that could potentially replace the income that I'm getting from my business? And similar to the story that you were mentioning with your wife, like when I'm looking at a deal, for me, I typically like to invest 25K into a deal, get about 7 to 8% return paid monthly. So I'm looking at about $200 a month just to make it pretty easy. And then you start to look over time, like, okay, if I get into two deals a year, that's $400 a month coming in. And then you start to do the math when you're looking, 5 to 10 years out, you're like, okay, this could be actually enough money coming in and replacing that income. But when you were going through and you were looking at these different properties that were out there, did you stay local to your area? Were you looking at single family rentals, multifamily deals? What was that sort of initial process that you were going through?
Yeah, local. It was local for sure. So I worked about 25 minutes or so from away from where I lived, and there was a small town there. So that's where I focused on. So I could leave at lunch, go in before work, after work, look at houses at the time, and try to underwrite them, evaluate them, see if they made sense. So we started with single family homes. That was, I was very risk averse. So I like people would see me now and probably maybe they just have the perception of something different. I don't know, but at the time, I'm still that way. I just understand like how real estate works very well now. But initially I looked at a lot of deals. I didn't pull the trigger. I probably over negotiated on a couple $100 or just stupid amounts of money that didn't make were irrelevant in the grand scheme of things. Like if I probably lost a deal or two over $1,000 or $2,000 when, over the course of 10 years, that's not going to really impact anything. So I just really overanalyzed things early on. But when we bought the first single family house in 2013, I started, okay, rent's coming in. Okay, I'm paying down the mortgage. And I could really understand like the different ways to make money in real estate. It just kind of clicked for me. Maybe it's the engineering mind. I'm like, okay, I need to do this again.
And I agree with you there on the overanalyzing. Obviously, like I talked about, I haven't done active, but just being a passive investor, I used to go on Marcus and Millichap's website and download their offerings about once a day. I would go find a new property, and that's when I was practicing underwriting and analyzing these deals. For those listening, I don't recommend it as the best practice because you have to sign an NDA, and when you're signing over the NDA, you give them your phone number. So now all of a sudden they see someone wants this offering, then you would get calls quite frequently all the time. And when you're looking at one deal a week, you're looking at say 20 deals a month if you're just looking Monday through Friday. It was quite a lot of calls coming in. But when it came to these properties themselves, were you self managing? Did you bring in a property management company? Did you wait till you got to a certain unit count where before you even brought the property management company? And just curious what that looked like early on.
Yeah, early on it was self-management. So in 2013, we bought our first single-family house. The light bulb clicked. I kind of understood how to do it. I understood how to finance it using HELOC, the Burr method, all those things we could talk about. But I started buying single-family houses, and basically for the next 4 years, on average, about every 3 to 4 months, I bought a single-family house. So like not crazy fast like these people that buy 100 in the first year, but also just relatively consistent using our own funds. And during that time, my wife, who was working less, as we talked about, less and less, was helping run them. I really focused on the acquisitions and finding deals, but then I would help set up the systems for the management company. And really is what came to like our next shift in 2017 time frame. We were having, I would say, a calm discussion, and she's like, I didn't sign up for this, as in I didn't sign up for, like, I'm a hairstylist. That's what I went to school for. I'm not a property manager. Now, she was very, very good at it, which was great, but just, some of the stresses that could come with it from time to time. So in 2017, we were like, do we sell? We were at 20 or 25 doors at that time. Do we sell these properties and just say, hey, like, let's just continue down the corporate path and do that? Or do we make a pivot? And we talked about it and we said, okay, let's make a pivot to multifamily where we can start to leverage the bigger management companies and things like that. So that was the plan, and we pivoted to multifamily in 2017.
And on the single family rental properties that you had, did you still hold on to them, or did you sell them and get out of that and then take the proceeds from those to go into the multifamily deals?
Great question. Basically, we have sold probably half of them at this point. Some of them they're just so easy to run now. They're long-term tenants. I mean, the ones that have lasted or stuck are the brick ranch, like the single family brick ranch with attached garage, just people staying there for a very long time, just small gradual rent increases. Um, but they just stay in there. But when people either if people have moved out, we said, okay, let's just flip this, fix it up, and sell it because we have the equity, and we'll roll that over to a multifamily. Or if there was a specific deal we had in contract or looking to buy on the multifamily side, we would maybe bridge the gap with a line of credit, but then sell a house to recoup it. We did some 1031s from single family to multifamily. So it's kind of been a mixed bag. What's really nice about single family that we own 100% of those is we have that equity there. It's not 30 days liquid, but it's probably 90 to 120-day liquid where we could sell those at any point in time if we needed some cash for whatever reason. We haven't needed that. So if it continues to be really easy, our return on our time for those is great between cash flow, equity buildup, principal pay down, all that stuff. So we'll just keep them unless there's a reason for the cash or liquidity. Or if someone moves out, we'll probably say, okay, hey, we've done well. Let's sell this and roll it to a multifamily. So that's kind of single family has been great and provided us a lot of flexibility as to what we can do with those.
Yeah, I like that story a lot. And I find it's a common story I find for folks that start off in the single family rental space where you start to accumulate so many units where it becomes to it's like how can I make it a little bit easier instead of me owning necessarily 25 single family homes where do I want to keep scaling it to 50 or 75, or instead of going off and buying another 10 single family rentals, maybe I go off and buy a 10 unit apartment complex. And I think it's just a natural progression for folks in the real estate space where for me as a passive investor, if I were to go active, it would be pretty daunting for me to go off and buy a 10 unit apartment complex. Just even a even if I'm talking a fourplex, if I'm not house hacking it and I'm managing four different tenants, it seems easier to start off managing one tenant and one house and then maybe gradually adding them up over time. If you could go back to when you're first starting this journey, would you want to keep it the way that it was where you progress from the single family rentals to multifamily, or would you rather just started and gone off and buy a quadplex or a 10 unit, a 20 unit from the very beginning? Has that shifted, or are you just did make more sense early on for you to get your learnings down, understanding the market, understanding how to manage a property before you went off and now you have these 10, 20 units and hiring a property management company where you could learn it all on your own and get that experience before necessarily scaling it up over time?
Yeah. So first of all, I don't regret how we did it. I mean, we could have started earlier. We could have went faster. We could have done things different. I don't regret it. But if I was telling someone that was, around the age of 30 and wanting to get started, had a little bit of capital where they could invest, how how might you go about doing it? I would still start with a single family, I think. I would really just, you just, like I talked about, a lot of things click. You start to understand a lot of nuances of the business, where that's how the financials work, how to work with banks, how to manage the property, setting up the systems. Like, if you manage one property, set up the systems like you are managing 20 or 50 properties. So I would buy one, then I'd maybe keep an eye on another one, but I'd look to go to four, a 4 unit next, and then I'd probably go maybe to an 8 or a 16. But I'd make sure I'm kind of grounded in each step. I'm conservative by nature, so I'd make sure like I have each step figured out and solid. And if I know how to do 4 really well, I probably know how to do 8 or 16 really well. And if I know how to do 8 or 16 really well, I can probably do 30 to 50 pretty well. Different numbers, different sizes, different personnel strategies, stuff like that. And then, that's now I'm stepping into the larger 70, 100, 150 unit properties over time. I don't think newer operators should be jumping to, um, really large units if they've just had some courses or not a lot of experience. I think, especially if they're bringing on investor capital, I just think there can be a lot of exposure to risk, and I think it's good, and not just for investors, for the person, the operator themselves, learning, you can do 1, 4, 8, 16. You can do that relatively quickly in your career span. You can do that in a relatively short period of time. So be patient, a little bit patient, do it right, and don't get stuck, putting yourself in a really bad situation that'll set you back financially 5 or 10 years. So I think that's how I would do it if I was telling someone how to approach it if they're 25, 30 years old.
Yeah, that's perfect, and I really like that because I have seen these operators in the space where they I think to a certain degree, you go on LinkedIn and it's almost touted being financial freedom. It's an easy way to make money, but I would imagine that it's definitely not as easy as it seems to be out there. And I think a lot of people have gravitated towards the real estate space, thinking of it as an easy way to get out of a corporate gig where they could go off and buy 100 unit apartment complex or 200 unit or even a 50 unit. You get a nice acquisition fee and then you get the monthly income coming in on top of that, depending on how you structure your deal and whatnot. And I'm more than happy to pay an acquisition fee, especially as a passive investor. I mean, I'm not the one negotiating the deal, finding the deal, handling the deal. I understand there's a time and place for that, but I find that these newer investors, they just scale almost like too quickly, where they go from 0 units to 500 units within 1 year. And me being a passive investor, I don't know if I necessarily want to invest with someone like that. I'd rather invest with someone like yourself, Phil, where you started small and then you gradually grew over time as you started to get an understanding of how everything worked. And I think if you look at any of these big sponsors and operators that grew so quickly, a lot of them aren't having a really good time right now. And this isn't to say that they're not a good sponsor or operator, but they just don't have those learning experiences of how to manage tenants, how to run a property management team or hire a property management team, depending on what your company does. So I think that's very good explaining for us. And again, I can just think of so many instances within like the last year or so of sponsors that just grew so quickly and it ended up not working out too well for them.
Yeah, and I look. There's a lot of work that goes into an acquisition, especially if done correctly. So I think acquisitions are fine. The nature of how we grew our businesses, the first several multifamily deals that we did was myself and another partner, and there was some different partners that came to me with deals and wanted to partner, or so I have different partnerships, but it was just us. So we didn't have investors coming into those deals, and we didn't have an acquisition fee. So we just did that work, and we were just trying to build equity and cash flow over time, and that's how we did it. Now we've eventually gone to where we had a deal earlier this year. We brought in investor capital. It's going great. We had an acquisition fee. I'll just say that it also made me like understand acquisition fees for newer investors can be, I think, dangerous
Mm-hmm.
because that if people are working for acquisition fees, like if that's the reason, the main reason is to work for acquisition fee. Like if I get this deal done, I get this big acquisition fee. That's true, by the way. People do get an acquisition fee, but if that's why people are doing it, like that's the job of the person evaluating the deals, is make sure you really understand the sponsor's intent, and are they doing it for acquisition fees? Like how are they going to get paid? Are they going to get paid from the cash flows just on the exit? Like understanding that model is important, because I think the fact that acquisition fees are attractive is why there's a lot of people in real estate that are finding themselves maybe in trouble.
Yeah, I agree. I agree with you there. And like I mentioned before, I totally get it. There's a time and place. You're the one going out there and doing all the legwork. We just want to make sure that the person is not just putting together these deals. And at least for me, what I can tell within the space is if I see a smaller sponsor or operator and they're pumping a new deal every month or every 2 months, and just knowing the current marketplace, maybe it's a big company. If it's BlackRock that's doing it, I understand that. Yeah, they have the
Sure.
resources. But if it's a small operator, they've only been around a year and they're touting new deals every single month. It worries me a little bit. And as a passive investor, I just wouldn't invest with them because I think that they're scaling too quickly. And I do wonder if they are going out there and just getting that acquisition fee. And then even then it's looking at, the memorandum that they put together is understanding like, okay, what happens to this particular deal. And not to digress too much further, but I know Phil, you're a member of LFI or Passive Pockets, and I think I saw someone in there where they invested in a deal and they didn't read the PPM, private placement memorandum, and basically it said something to the long lines of, if there's a capital call and you don't participate in this capital call, your shares are going to be diluted down to 0%. So they're
Oh.
forcing your hand and to invest in these deals. So, and they weren't sure whether or not it was either, could it be there's an opportunity where the deal is going to be 100% capital loss, or do they make it 120% capital loss by participating in the capital call? So
Right.
you do have to
Right.
just, yeah, exactly. You just have to make sure you're doing your due diligence on the sponsors that are out there, and it's really dry to read that. To be honest, no one wants to sit there and read
Yeah, it
read it.
is, and but I agree it's so important. And I think back to just to kind of close out the, a newer sponsor operator that's scaling, growing really fastly. You question that. Okay, do they have the capacity to to like really do acquisitions and underwriting and close deals properly? And are they just attracted to the acquisition fee? But also, there's a lot of work to run these deals and operate these deals properly. And if you're growing too fast and you're taking on a lot of new properties, whether you're property managing or asset managing, but at a really fast pace, or their management company that their third party going to is taking on a lot of deals at a very fast pace, there's so much dependence on the operating side of property management, leasing, marketing, all just your maintenance team, your capex plan. There's so much operation. So if someone's growing too fast and their mindset and skill set is not ready for that growth, it's probably not going to go well. Like, they need to grow their mindset, skill set with their business or ahead of their business, um, not not your business way outgrowing your mindset and skill set. So I think that's why a growth plan, slow, steady, is probably from an investor perspective, is probably the better route.
Yeah, it's spot on. And just to add one last little tidbit in there, something I take a look at is when it's a newer sponsor, are they staying in their local market or are they staying, say, like I feel if you were investing, you're a newer investor, obviously you're experienced. Let's say you started in Ohio, then 6 months later you're in Florida, then 6 months later you're in Texas and Arizona and Georgia and the Carolinas. Like how you have a good understanding of all these markets when you've only been doing it for 6 months every year? And that's something else I look at. Do they stay in their local market, or their, I say local, let's say 3 hours of their surrounding area?
Yep.
They have a good idea of what's going on. And speaking of that, when you're going out there and you're finding these multifamily properties, are you still staying local to your area, or are you more expanding, say, into Indiana, Michigan, Pennsylvania, or are you more just staying in Ohio and in your surrounding areas?
Yeah, for us, we've been fortunate to really be able to stay pretty local. We're like in the Dayton, Ohio, and surrounding markets now. Our management company that we're really comfortable with and have partnered with a lot, is in Columbus, Cincinnati, Indianapolis. So we're looking for deals in those markets as well. So as deals get a little bit farther away, we'll third party, and if deals are closer to us within like a 45-minute radius or so, we're self managing those. So we've got kind of gone back and forth on that a little bit, depending on the type of deal and size of deal, because we had some stories, just our capital, but just in 2017, 2018, our first multifamily, the management company it did not go well. We had to change management companies, all kinds of stuff. But anyway, we've learned a lot from that. So because of that, the markets, like, will we slowly expand? It's just like how fast you grow, how far you expand out geographically. I think you could say the same kind of lessons, because I've invested in a lot of passive deals as well. And if I'm investing a deal in California or Texas or Georgia or Florida, I just don't know those markets like I know Dayton, Ohio. In Cincinnati, I I know, like, I've been there many, many times. I know that market way better than I do somewhere further away. So, like, slowly building that out, I think, is the right approach versus jumping kind of all over the place.
Yeah, I like that. I like that a lot. And for the deals that you're going out there and finding, and I say like in my local area in New York, I'm not going to get a ton of appreciation on my deals, but I could go out and buy a $200,000 four unit and get $4,000 a month in rent, and after capex and vacancy, make a nice monthly cash flow. But in 10 years, the property might be worth 225,000. So there's not a ton of appreciation there. When it comes to the deals that you're going out there and finding, is it more, say, a Class B property that you're upgrading? Is it your typical multifamily value add deal? Is it more cash flow with maybe a little bit of equity? Is it more like the burst strategy where you're doing that forced appreciation on a property? It's just curious how you're finding these deals and sort of what your strategy is as a company.
Yeah, our best deals we found is generally direct to the principal, direct to the owner, direct to seller. But we certainly have great relationships with it. You mentioned Marcus and Miller Chat, but there's other brokers in the area too, and we have good relationships with them. So from a finding deals perspective, just staying connected, just you know, being responsive. Hey, yes, I'm interested in this deal. No, I'm not interested in this deal. Here's why, or I'm focused on another deal, whatever it is. Just being communicative with them when you're finding deals, I think is really, really important. And then the types of deals we're looking for is generally first value add. Historically, a lot of deals we've done are probably like C plus class properties that we can maybe elevate from a C to a C plus, or maybe we can get from a C plus to a B minus. I don't know. Um, we'd like to navigate more towards B class. We bought a B class and it's running great. And the nature of the value add can be a lot of different things. I mean, it can be just a matter of, hey, they really don't spend any money on marketing and advertising, and they're not very responsive. They don't communicate very well. They have, virtual showings only, or somebody like no one will pick up the phone. So we can do, like, it's just the general marketing and sales approach to it. And then of course there's capital value add, exterior or internal. So we've done a mix of them, but we're definitely looking for value add deals in general, B, C class. C
Yeah,
class, by the way, if it's a C class, we want there to be a bigger lift on it if we're going to do a C class than a B class, because of just the effort required to flip a C class, I would say.
yeah, that definitely makes sense. And for the properties themselves, how are you financing them? Are you using, seller financing? I know you mentioned early on maybe using a HELOC into the Bird method and pulling out the equity. Is it pulling out the equity from some of the single family? I know you mentioned had raised some investor capital to purchase a deal not too long ago. Just curious how you've been able to structure them and really finance them.
Yeah, I mean, so from a equity perspective for the structure, is as of late, and what we'll be doing moving forward is, unless it's a smaller deal that we might just take down in house, we'll allow our employees to invest, by the way, which I think is beneficial and says something to our investors, like, hey, if we're willing to have our employees investing in these deals, they're gonna own it, literally own it. They're gonna probably run it really well, and we have a great team. But investors, and then nothing fancy on the structure. And then we typically, like, if it's depending on the size of the deal, I like using bank debt to close the deal, repositioning it, and then reassessing whether I want to go Fannie Freddie longer term to get to non-recourse, but also generally a little bit lower rate, just less flexibility. So in a potentially downward trending rate environment, I like to have that flexibility, which is why I use bank, and we can get really, just the nature of where we're at, I can get really, really good bank debt terms. There's just a lot of competition. And if you're a good operator and you present things well and you have a track record, you can also get good terms on the prepayment, rate modification terms. I want those written in right now so that in a year from now, if I want to do a rate mod, I know exactly what that rate is tied to and what I can do. And then once we repositioned it, okay, does it make sense? Do we have enough debt service coverage where we roll it into a Fannie Freddie non-recourse, and knowing what our longer term plan is because of the prepayment penalties and the nature of those types of loans. So generally we close with local bank debt, but then, like, we've refied one or two properties to Fannie or Freddie.
Yeah, that was always something that was interesting to me, was the prepayment penalties and and what comes with that. Because I mean, if I pay off my house, then my house is paid off for. But when you start to get into the commercial properties, I mean, I guess it makes sense from the bank standpoint. They want to make their money on the interest that they're getting. But that was something I thought was interesting. Where if you pay off the property early, and not to say that you would, but potentially having that prepayment penalty out there, I think that was something that was pretty interesting to me. As you've been growing your portfolio, are there certain things that you could look back on that you wish you would have known now, whether it was hiring a property management company that maybe, let's just say, they just didn't do a good job. And I've, early on after I graduated college, rented a couple different apartments, and I could tell you a good property management company from a bad one just based on my experiences and how they manage things. Was it maybe how you finance the deals? How maybe it was the deal itself. Maybe you overpaid, or maybe you thought you got a good deal and it ended up being a lot more work than you anticipated it being. Just curious, some of the learning experiences you've had over the last 7 to 10 years or so.
How long do we have, Trevor? Look, I'm not going to deny that we've made plenty of mistakes, and I think we've learned a lot. I mean, management, we've gone back and forth on in-house versus third-party management. So now any smaller properties that aren't big enough for like a really good third-party professional management company and more local, we're going to manage those in-house, and we have a great team that does that really well. We built the systems and processes. We use Appfolio, which is a great software. So from a property management perspective, we've learned so much. I think we talked about it, but how you finance the deals needs to align with your business plan. So whatever, if it's a value add reposition, would like to sell in 3, but want to have the option to hold for 5 or 10, like make sure your debt structure supports your business plan. So critical. We had a property that we refinanced 3 years ago. We paid a pretty big prepayment penalty on it to roll it. It still made sense to do, but I wish we would have had that discussion earlier with the bank to maybe negotiated that prepayment penalty a little bit differently, because I think we could have. Um, so and then yeah, I'd say those are the biggest things. Is how you manage and operate is so important, and we've just learned a lot how you finance things. Um, on finding deals, relationships are just everything, and building your platform um, around who you are and what you represent. And I heard something like, are you willing to put your last name on your business? And I was like, okay, that makes sense. And we're doing that. And it means a lot to me. It means a lot to us. So we're going to do things the right way. We're going to operate the right way. We're going to treat investors correctly, all those things. So
Yeah, that's spot on. And I know we've been talking very much about the active side, but I know you've done a little bit of passive investing. And I'm just curious how that experience has been. Have you also been a passive investor in multifamily deals? Have you done any other assets? And yeah, just curious how your experience has been being a passive investor.
yeah. So, kind of the story there is in 2022. I think we were self-managing, and I think there was a property that was kind of a pain in the what, and we're like, okay, let's refinance this, let's hand this off, and and then let's roll some of this money into passive deals. So that's kind of the nature of how I got into passive investing. And in hindsight, this is one of those things where maybe like the verdict's still out on how those deals end up. Like I haven't had to do any capital calls or anything like that on deals, so that's been good. But time will tell as the market comes back. I'll just say that our deals that we've been managing, been running, even been buying, have been running and growing up and to the right. So I've learned a ton from it. We've invested in multifamily, we've invested in land, we've invested in self storage, we've invested in mobile home parks. We've invested in development deals. So we've invested in quite a few different types of asset classes. And I was doing that alongside, like, we had a small group of people that were evaluating deals together. So I learned a ton from them. So again, fortunately, it's gone pretty well. The cash on cash is just tight right now. We didn't invest in any deals that have floating debt, which has probably been a lifesaver because of the taxes and insurance and some other things that happen throughout the country. And really, I learned a lot about um, trusting and betting on myself, maybe, and in what we're doing here, and we feel good about it. So that's how we'll be focused moving forward. But I would just say be really thorough, really diligent if you are passive investing. You talk about that a lot. You know that yourself really, really well. But just be thorough. especially on who the operator is and their background and track record, responsiveness, all those types of things.
Yeah, that's spot on. And it sometimes when you're online, it makes it seem easier than it is. It's everyone talks about an alternative to investing in the stock market, but for me, if I invest in an index fund, let's just say total stock market index fund, the likelihood of that going down to zero is probably next to nothing because that means the entire economy would be blown up and every single business in America would be out of business.
Right.
So, but I know I'm not going to make as much money necessarily there as I would investing passively in real estate, but the consequence of that is I could potentially lose all my money investing in real estate. Not that I ever go into any investment deal thinking I'm going to lose all my money, but you just want to make sure you're vetting the sponsor, make sure you're doing your due diligence, making sure that hey, if I'm going to have this money tied up for 5 to 7 years, is that going to be okay with me? Where I could go off and sell some stock and get some cash. So I think those are just
Right.
questions you need to ask yourself as a
Yep.
passive investor.
And I think it's important to know the debt structure, the capital stack. Like those
Mhm.
things are really important from an just to understand the downsides. Like if there's a hard pref equity group that's involved in it, and then like what's the LTV, all that type of stuff. Could they force something? Like there's just a lot of questions to ask and to understand. Um, yeah, about both the operator, the debt structure, things like that.
Yeah, that's spot on. And like you mentioned, the capital stack, that's been another area where you have to know like where do you sit with the debt? When are you going to get paid back? Are you going to be the last person to get paid back? Just in the event that hopefully it doesn't, but the property gets foreclosed on and they get some money out of the property. Who's going to be getting paid first and how much? So I think that's an important part of it as well. But Phil, I wanted to ask you if there is someone that is investing in real estate, maybe they're starting their journey as an active investor, maybe they've done a little bit of passive investing, looking to get more active. What's the best piece of advice that you'd give them?
Yeah, I think the you know, two things I would talk about is first get clear on what you want out of it. I'm going to say three things. Get clear on what you want out of it, clear on what you're doing and why. That's number one. Number two is have a growth mindset around educating yourself and associating with others. It's just so important to learn from books, learn from podcasts, learn from others, whether that be a business coach, mentors, whomever, but like try to get yourself in rooms where you don't know if you belong there, because if that's the case, you're going to learn from the people around you. They're going to elevate you. So just having a growth mindset is the second one. And the third one is you got to have the courage to take action. You got to go do it and do that. Taking action doesn't mean I have never done a real estate deal. Now I'm going to go buy a 100-unit property, but it means go buy a single, just a single family house, or go buy a quad, or go invest a small chunk of money into a passive deal that you've vetted really well. Don't invest your life savings all at once. Like take your time and if you do those things in parallel, it'll also like they all work together. So if you get clear on what you want, you start to educate yourself, and then you take action, you're going to learn what you liked and didn't like, and you might change what you wanted, like realize, okay, that's not what I wanted. I wanted something different, and that's okay. That means you're growing, right? So just those three things, I think, they're kind of a continuous cycle of growth um, that you can get from those, and you'll probably have success by doing those things over and over again.
Yeah, I think that's all spot on advice. But Phil, I just wanted to say I really enjoyed our conversation today. And if there is someone looking to learn more about you or your company, where should they go to?
Yeah, thanks for that. We have a podcast, the Moeller Real Estate and Business Podcast. So excited to have you on as well, Trevor. Um, but the Moeller Real Estate and Business Podcast, you can check us out. Our website, MoellerRE.com. LinkedIn, you can find us there. We'll post stuff there on different social platforms. That's probably the most common one that we like to. So whatever's easiest for people to go about finding us.
Awesome. I'll make sure to include that in the show notes of today's episode. And again, Phil, thanks so much for coming on to the show today.
Thanks for having me. I really appreciate it.